finance, this workshop is definitely for you. With a comprehensive guide to managing your personal finances, covering essential topics such as budgeting, saving, debt management, investing, and planning goals for your future. Please put your hands together right now for our presenter, Mr. Roland McIntyre.
Thank you. So glad to be here. I'm glad y'all are here. Before I get started, I want to tell you a little bit about me before we get into the presentation. I started Mountaintop Wealth after the COVID-19 pandemic. It was a situation where it was a lot of life happening during the pandemic. I'm sure all of you all dealt with it. We had so many different things going on, from societal changes, from things like George Floyd. We had things like the economic changes, and then we had inflation, and then we had the stock market changes. And there were so many people out there looking for financial help and guidance. And with my experience now as a financial advisor with 12 years of experience, being a certified financial planner, and now the owner of Mountaintop Wealth, we really get the opportunity to help people reach their financial goals. We really help people relieve that stress and get that clarity and confidence to really do things that they really thought they didn't think were possible. So what we really like to say is, at Mountaintop Wealth, you get the opportunity to turn your finances into freedom. So I'm so glad I'm here today, and just as we get started with this presentation, just to let you know, this is not specific investment advice. We'll have some good information on here, and we'll see some information about some stocks. This is not a recommendation to buy any stocks. This is for educational purposes only. But I'm definitely happy for you to follow up with me, have a conversation with me, so that we can really help you reach your financial goals and reach that financial freedom. All right. So, what are we going to be talking about? Well, we all know as entrepreneurs, myself included, that you're juggling a lot of different things. A lot of things are going on. And that can be stressful, that can be fun, that can be exciting, but there's not enough time in the day to get all the things that you want to accomplish done. The real big thing that a lot of entrepreneurs face is they're so focused on their business, but who's really focused on investing in them? Are they investing in themselves? Are you investing in yourselves? So today in this presentation, what we really want to talk about is, how to build personal wealth and do it in a simplistic way that you can understand and be efficient with growing your business and also managing your money correctly. Okay. All right. Now, before we get into the personal finances, we do have to talk about a couple of core financial education topics. And one of them is the word a lot of people are interested in or fear, and that is stocks, also commonly called in the financial world equities. These are simply just companies. Some of the big brand names that you see on the screen, whether that's McDonald's, whether that's Nike, whether that is Coca-Cola, Apple. These are just companies that are publicly traded, and when you own stock, you own a small percentage of that company. Just like individuals that you're seeking to maybe raise funds for your business, these individuals that want to own a portion of Apple, Microsoft, whatever the company may be, they see a potential value and growth in that company, and they want to invest in it because they see something that in the future could be very beneficial, and they want to be a part of it. Another core item, bonds. Not really talked about as much as stocks, but it's important for folks to remember. It's like an IOU, it's a loan. It's a loan. And with bonds, the way you make money is you're earning that interest. People commonly call it fixed income. As a fixed income investment, you have some predictability. Every so often, you're going to get that interest as long as you have that bond held, as long as at this point, if you own a bond, you've given someone a loan. You've given a company a loan, or maybe that company has given you a loan. And what they're expecting is to be paid back. And that not only do they want that back, but they also want that interest back. So essentially that bond, as that bond is getting paid, someone is making money off of it. Now, it's not as much as a stock, because that stock growth can be unlimited. It can go down, it can go up, but the bond is a little bit more set. It's a little bit more predictable, and it feels a little bit more safe to people. We'll talk about is that really the case here a little bit later. Okay. Third and last one, our mutual funds. And we put all of these things together. Mutual funds, index funds, ETFs. These are collections of investments. So these are stocks, bonds, cash investments, all put together in a wrapper, or put in together in a fund. People also may call it a portfolio. And all they're doing is putting these different investments in them, picking and choosing which ones may be good for the investment, good for the actual growth of the fund, so that they can have less risk in that investment. And a pool of people buy into this so that they can benefit from it as well. Another important thing with a mutual fund or an ETF or an index fund is that there's someone that's in charge of actually making the decisions of what actually goes into those funds. This is called a portfolio manager. This is not the person that you usually run into walking around Chattanooga. That portfolio manager is probably somewhere in New York or in California. But that portfolio manager is the person that's actually doing the day-to-day changes of a mutual fund or an index fund or an ETF. Okay, so I want to give you an example of an index fund, and that is the S&P 500. Anybody heard of the S&P 500? Anybody? Come on. I think so. All right. So with S&P 500, I really think that it's a great way of getting an idea of what the stock market is doing is by looking at the S&P 500, because it tells you about 500 U.S. companies. And it's just a way of telling how those companies doing at this particular point in time. Are they rising? Are they falling? What's going on with the economy? Looking at the S&P 500's growth can be a way of you understanding what's going on in the economy, and also if you're making money or not. If you're invested in a S&P 500 fund, an index fund or a mutual fund that is trying to mimic the S&P 500 would have all of these different stocks that are in the S&P 500. Those are 500 U.S.-based companies that are growing, some are declining, whatever's going on, but it's a great way of getting a diversified look at the U.S. economy. So, we talk about stocks, we talk about bonds, we talk about mutual funds, but we also need to talk about how they grow. And this past winter, I think that was in January actually, when it snowed here, we got outside, my wife, my son, we got out there and we started trying to build a snowman. And it wasn't like Elsa in Frozen. I was struggling. I was trying to get this snowman built. And it was a neighbor across the street that saw us, and they had their snowman. It looked so good. And I'm like, oh, we got to do something. Like them, so figure it out. And they told me to, hey, take those little balls that you're doing and start rolling it. And just let it build up, and then get another one, and just play. And it was like, of course. And I started doing that, and it started working, it started building, and the little ball got bigger and bigger and bigger. And that's really how compound interest works. And this compounding really makes a difference when you're investing, because a lot of people think that, hey, I put money in, I earn a set amount, and I make that set amount each time, and not necessarily. And I want to show you a quick example. You don't have to do any math, don't worry. You're not going to be tested on this, but I want to show just a little example of how money grows over time. So So you had $10,000 at a 7% rate of return. So that's just how much the money is making each year. That's all that's saying. And as you can see, that first year you start out with $10,000. Well, the next year you've earned 7% off of that money. So that money has made money. So now you're not starting at $10,000. You're starting at $10,700. So that snowball is slowly getting bigger. So you have a base, your principal, that's start amount, but then the next year you get a little bit more, and the next year you get a little bit more, hopefully. The longer you do this, you really, really get to see the effects of it. And I'm going to show you that a little later here. But trust me, it's going to be worth it. But we have a problem. A big, big problem. It's Thanos. No. Inflation. If you're not investing, if you're not saving, your money each day, regardless of your saving or investing, is getting reduced by the constant growth of inflation. So people don't really realize inflation until it hits you in the face, until you look at times free prices, we see home values shoot up in property, taxes are now going up, and then you're like, wait a minute, this is ridiculous. Or your egg prices are going up. These, again, inflation. But after COVID, it was outright horrible. So we just were talking about rates of return just a moment ago as far as your investments, but look what inflation was doing to your budget. So 4.7%, 8% in 2022, and in 2023, 4.1%, which was actually an improvement because it went down from the year before. Inflation really is something that really destroys what we call your purchasing power. So when you go to the store and you buy something, even if it was like when I was a kid, you could go to the store, you could get some chips for $4, you could go get some chips, a drink, and a pill. And you can't do that now. But what it's doing, as you see in the example up here, over time, the purchasing power and the value that you have really starts to have an effect. And you think of things like gas prices. Anybody in here can remember when gas prices were below $1? Mm-hmm. You're showing your age. Me too. But it was nice, wasn't it? Okay, I go back to that age, I go back to those gas prices. But we can't. And as inflation has went up and as time has went on, it's really, really starts to have an effect on people. So, the real risk that people are missing is that whether you like it or not, you need to be doing more than just spending your money. Because if you don't, inflation is going to tear you up. Now, there's other things out there, but inflation is one of those sneaky ones that, we talk about lifestyle with personal finances, we talk about debt, we talk about a lot of different things. And we talk about inflation as well, but we don't talk about what to do about it. So what should we do? How should we combat inflation? Well, one of the things you can do to beat inflation is actually invest for the long term and grow and build your personal wealth. You see, she's wrapping her hands up. She's getting ready for a fight because every day your money is out there fighting. And if you're not saving, if you're not investing, guess what? It's losing. Because inflation going up, whether you like it or not. You can look for deals. It doesn't matter. That inflation is still going to go up. Now, some of you may be thinking, wait a minute. Stocks, investing, are we going to be talking about personal finance? Trust me, we're talking about personal finance. Because the stock market is risky. The stock market may cause me to lose money, and I don't want to lose my money. So what should I do? The first thing I want you to realize is, over time, your money grows when you invest for the long term. Your money, actually, if you don't touch it, can build and grow this way for 10, 20, 30, 40, and in this example, 50 years. 55 years. But what's going on in this chart here is this account, the person invested $5,000 in 1970. Just $5,000. They didn't do a thing, but invested in an S&P 500 investment fund. And somehow, they didn't go into it, they didn't touch it, and that money grew and compounded, and that snowball got bigger and bigger and bigger. And even though they had things like Black Monday in the 80s, where the stock market just suddenly dropped, whether it was what happened on September 11th, whether it was the 2008 financial crisis, whether it was the COVID pandemic, it didn't matter. If you stayed invested for the long haul, your money was going to make much more money if you continue to do so. But during those times is when you're tested, when those scary things happen, when things like tariffs happen, when things like the pandemic happen. Many people want to then take their money out. But actually what's going on is, really, if you were shopping and investing, think of those, I think people look at those the wrong way. When you see a deal when you're shopping, you don't say, oh, I shouldn't buy that because the prices went down. But when you're investing, people tend to get worried when the price goes down. But when you're investing for the long term, that's actually a positive for you. That's actually a time to keep on your money, to stay consistent, to stick with it. Because now there's an opportunity for more value for you to contribute. And you can actually benefit from that growing and appreciating wealth. Because when you're doing things that the rest of the folks ain't doing, it really allows you to build and grow that wealth. And the thing that happens is you start looking at the news, you start looking at Instagram, you start looking at Facebook, you start looking at the talking heads, the folks that's telling you what the economy is doing, what's going on with this company, what's going on with China, what's going on with this CEO, what's going on with this thing. And I just want to let you know that you gotta just
turn the TV off, turn the TV off, TV off, turn the TV off, turn the TV off, turn the TV off.
Thank you. Turn off the TV, turn off the noise, and stick to the plan. Got to appreciate that, bro. Thank you. So you say, okay, I can do that. But stocks, those are risky, man. They move around so much. That makes me a little queasy. Well, what about other things like CDs and bonds and high-yield savings accounts? They're good, but they're not for growth. And what you need is growth. In your business, you want growth. Those bond returns, historical bond returns, all the way back from before the Great Depression, show you that a real rate of return when inflation is included is your money would only be growing about 3%. Because inflation, as we saw in the last few years, has historically been only 3%. But what we've seen recently is inflation can get a lot higher than 3%. 6, 8, 4. So how much is your money really earning just sitting in the bank? Not much, not at all, and you're losing purchasing power. You gotta do something different. What I really want you to do is stick to the plan and get the help of a personal financial advisor. You have advisors for your business. You have people who coach you, teach you about your books, teach you about your business plan, that teach you about your pitch. Do you have someone coaching you on how to build your personal wealth? Because trust me, if you're not taking care of your personal wealth, it will eventually affect your business, because you'll never make enough. You'll get it, you'll spend it, and you'll keep that cycle going. Whether you're an entrepreneur or not, you have to be looking to build generational wealth. That financial advisor is there to keep you consistent. He or she is not there to help you pick and choose stocks each and every other day. They're not sitting there trading that stock each and every day. They shouldn't be. What they should be doing is just like when you develop that business plan, putting together a comprehensive guide for your money, for your wealth, and how to grow it, and how to stick to a plan with different alternatives and different things available, so when certain life events happen, you know where to go and what to do. Those contingency plans that you have for your business, you have that built into that comprehensive financial plan. Having a financial advisor helps prevent you from making those impulsive decisions. Crypto, Doge, and all the different new investments. Should I be investing in AI? Should I be investing in green energy? Whatever the thing is, it will change, it will come, it will go. But what is your plan? Because every time the wind changes, should you? Everybody knows the story, or I know if it was my family, and a lot of people here, if somebody else gonna go jump off the bridge, are you gonna go with them? Just because somebody else is doing something cool and they're making money or losing money, whatever the case may be, doesn't mean you have to do it. That financial advisor is there to keep you disciplined and keep you from making emotional, impulsive decisions. Because when your job changes, when your business changes, when tariffs affect your business and it spikes the cost, you may want to go change and do some things with your personal life. You may go spend more. You may go take some money out of some accounts. You may want to move some things around and not consult that advisor. That advisor is going to help you. That advisor is also going to not only help you with the money, but they're also going to help you with the taxes. And I know as entrepreneurs, y'all hate taxes. Hate dealing with the taxes, hate looking at the taxes, hate getting the paperwork for the taxes. But really, the taxes is a little cheap though. It's a way to build your wealth. And if you actually use it strategically, you can use that tax code and that tax system to leverage your business and grow your personal wealth by making sure that you're putting the money not just in investment accounts, but in the right types of investment accounts. You've heard of the phrase, don't keep all your eggs in one basket. This is what we're talking about. Okay. Again, a financial advisor is not just here to, you're not getting the value from your financial advisor if they're just recommending stocks and bonds and mutual funds. That shouldn't be all they do for you. It's these little changes that make a real big difference. Setting up your investment plan and actually putting it on an automatic contribution so that you contribute whether you remember to or not each month. Putting money into your emergency fund, because you know you're an entrepreneur and you know you need more than 3 months because life and business be doing its thing and you don't know what's going to happen next. So you know you need to build an emergency fund and you need to have a set amount or a set percentage. When I grows this, I'm paying myself this and I stick to it. Financial advisors help you make that little difference because you don't think about it then, but then when the problem comes, you are so thankful that money is there. And when that stock market starts going crazy, instead of you panicking, worrying, or when that job changes or something happens to the spouse, their job changes, you have that emergency fund. You have those other accounts. You have that money that you can go on vacation with. as I come to a close, and we'll have questions if there are any here momentarily. It's okay to get help. It's okay to not have been taught this. It's okay for you to say to yourself, man, hey, nobody taught me this in school. My parents didn't talk about money. My parents had a situation where it was just not something we brought up. That's okay. That's a start. You're recognizing, hey, that's the situation. But it can change. There can be a difference. You can change your family's financial future. You can build generational wealth. You wouldn't be an entrepreneur if you didn't think that was possible. It's okay to have questions. You don't have to know it all. Don't hesitate to reach out to a qualified, certified financial planner like myself and Mountaintop Wealth so that we can actually help you reach your financial goals. Here's my contact information, and we can have a conversation. We can talk about it. We can talk about how you can actually turn your finances not just into freedom, but into power. Also, there's a little podcast out there. Check that out too. Appreciate that. And you'll see that link. That link takes you to all of my information, my website. It takes you to my email, all of those different contacts of information. We have a wealth of financial education resources. It has some things that we provide for you, even for those people that may be not entrepreneurs. We have some things for you as well, where you can have a conversation, so you can grow and build that wealth, whether that's for your retirement, whether that's for your child's future. Whether that's because you've had that 401k at that job from 4 years ago and now you're an entrepreneur and you still haven't did anything with it yet, you need to call me so we can talk about it. All right? Well, with that, I'm going to open it up for questions. All right. Well, come on. Yes,
I just wanted to understand if I wanted to work with you, is that more of a one-time investment where I hire you and you help set things up and I'm kind of on my own? Or is it a thing where it's kind of a long-term investment where you get me started and we're checking in? I would just want to understand how that works.
Oh, I would love that question. Thank you for asking. With Mountaintop Wealth, we definitely provide fee transparency, price transparency, and we also provide a diversity of options. That's why I started the firm, so I can make sure I can help people who normally don't fit into the normal financial system. So yes, if it's what you're looking for is a one-time or just a short project engagement, we can do that. We have to talk about the scope of the situation. We have to talk about what it's going to take. We have to talk about is it possible, is it feasible, is it within the necessary timeline? And that'll kind of give me an idea of where you're at. And we go from there. We have a set monthly plan for certain items. Maybe you can't afford the full amount. We'll do payment plans. And even if it's, hey, you can't come out of your pocket, because I'm a flat fee financial advisor, I don't charge commissions. You don't have to buy insurance from me, even though I will help you with insurance. You don't have to buy insurance because I don't make money from insurance, so I'm not trying to force you to buy something or buy a certain stock because I make money on it. It's free, transparent financial advice that we want you to execute. And if you're having a problem executing, that's where that value of the personal financial advisor comes in, because we're going to help you not only give you the recommendations, but actually help you follow through and help you organize, strategize, and mobilize that plan.
Hi, Roland. I'm Amanda.
Hi, Amanda.
Thank you. So you gave two examples, or many examples, but the 5K to $1 million,
Yes.
right?
Yes.
So that's a one-time investment. Over 55 years, right? Now, you also, I thought I heard you say something earlier that in order to beat inflation, you have to continue investing Is that true? Is that something you said?
Yes, so I want to provide a little bit of clarity. That chart that I showed, it was, yes, from 5,000 to $1 million, but that was over a long period of time. So I just want to make sure that's clear. I'm not saying that's going to be a guarantee that your $5,000 is going to turn to $1 million. So yes, that chart is accurate in regards to that. Just keep in mind of the timeline there. But yes, if you're going to beat inflation, you need to stay invested. Going in and out of the market actually causes people to lose money. There's several studies and surveys that show that, hey, the investment returns that you have at any investment fund, they may be, let's say, for example, 10%, but what the actual real rate of return of the actual investor is probably 8 or 7 or 6, because they didn't stay invested. Because the thing happened, whatever the big thing was, whether it was in their personal life, or whether it was something that was just on the news, they changed their investments, and they were not consistent. So that compounding interest is where you're staying consistent, and that money stays invested, and it's building and growing over time.
Right, so I'm trying to differentiate between staying invested, which
Yes.
I'm hearing is don't pull out when things get shaky.
Sure.
But then are you also saying we need to keep putting more money in
Yes.
every year?
Yes, there was a slide there, and it was about, it mentioned a reference to dollar cost averaging. Thank goodness. You should be able to go back to it. Let's see. Here we go. So, yes, the answer is yes and yes to both of those points. Dollar cost averaging is a secret. It's a secret. It's really is the thing that, whether the stock market is going up, you buy. When it's going down, you buy. It's a consistency. And you'll get things for a lower price because you buy every 2 weeks. You're investing every 2 weeks no matter what, because that's what's coming out of your paycheck, or every month because that's what's coming out of your account that you set up. And you're not worried about what the market is doing because your timeline, your goal is 5, 10, 15, 20 years down the line. So dollar cost averaging helps you turn that TV up.
And my other question is going to open up a huge can of worms, so I'm going to call you instead. But I saw the C word on the screen, which was cryptocurrency.
Mm-hmm.
And it's a big topic, but
Yeah.
your firm addresses that to an extent or not really?
Cryptocurrency in itself is not a good or bad thing. We do help people with if they have those type of investments, but it's not something that we outright push or recommend. We look at each situation differently. Most of the time, with an investment, cryptocurrency is a really blockchain that I look at it as a technology rather than an actual company. Now, so normally with my firm, I'll be transparent with you. If you're interested in crypto, there may be some companies that are utilizing that technology which may be more beneficial than outright just going to buy some type of digital tool out there that people are excited about. We want something that drives it. We know that your businesses that are out here, we know that there's a company, there's people, there's brain power, there's actual mechanics, there's patents, there's things that are protected and growing. With these cryptocurrencies, some of them, not all of them, it's just hype. And we talk through those things, but there is some value in some things that people want to go for, and there's a small place for that as well. For some.
Thank you.
I was wondering, I have a personal private wealth account with my trust that I inherited over at Regions Bank. Could I bring you in as like a third party with my advisors that I already have? Because you sound like you have a lot of good ideas.
Oh, thank you. I appreciate that. And the answer is yes, maybe. Absolutely. We could talk more about that. I have a few.
I'll definitely reach out.
Yeah, we'll have a conversation about that.
I'll listen to your podcast.
Oh, definitely. Thank you. I appreciate that. Look forward to talking with you.
You're my favorite person.
Any other questions? Okay. Well, sir? No? Are we good on time?
A few minutes. Yeah, 2 minutes. 2 minutes.
Yes. 2 minutes.
So, Roland, first of all, great stuff. In full transparency, I'm also a financial advisor, so I'm seeing what you got up there. I think one of the things I struggle with in handling accounts for small business owners, they're always asking, how much am I investing back into the business versus how much am I investing to stay above that rate of return that we need to stay above. Can you speak into that a moment about that trade-off between into the business versus personal?
Yes. And I'll go with something some people would say maybe it's basic that they've heard all before is try to keep your business accounts and your personal accounts separate. One of the reasons I start with that is because so you can really get an idea of what the business is doing and as far as in what you're spending on the business versus what you're spending just in your personal life for your family. And you start to really if you can get a hold of what your business is doing and also how your personal finances are doing, yes, I think that really helps that conversation coming into it. So if you don't have that understanding and you don't have that separation, things can get a little bit muddy. But also setting certain things, you want to have certain goals, and they don't have to be these big lofty goals. You got to really start with some small objectives and say, okay, when we get here, we're going to reevaluate this. So if you are growing and building in that business and you want to actually, you want to take a distribution or something from that business, there's tax implications, there are personal implications as far as what you're going to be using that money for. You have for the business, you have for personal, and from there we can really talk about as far as that rate of return that you're getting back from it, and whether it should be on the personal side or should you be investing back into your business. The answer is yes to both. You should be putting some money aside as far as personal and also towards that business, but making sure you have a consistent plan and objectives. So once you get to a certain level, then we can open up a little bit more possibilities for you.
All minds clear? Can we show Roland some love, guys? That's the real man right there. That's the real $1 million man. Hey,